Hello, everyone. My name is Alexander, and I have a pleasure to welcome you to today's seminar panel discussion, which will consist of two parts. In the first part, we'll have our PhD students at Bocconi University, so GFS students, Timur, who will present his views and his analysis of the US economy using the risk management approach. And it will take us from 3 to 4 p.m. And then in the second part of our seminar, we'll have a discussion also based on the case analysis and building scenarios for the US economy. We'll have our keynote speaker, Narcis, who is a deputy, who was a former deputy governor of the Central Bank of Armenia. And his contributions are extremely valuable to both us as the Central Bank of Armenia, but also to constructing the FPAS Mark II framework in general. So, but we'll be talking about it later on. We also, alongside nurses, we also have other GFS students who will be sharing their insights on the topic. But first, let's focus on the first part of our session. So, Timur, we are looking forward to your presentation, and please take the floor.
Yeah, thank you very much for introducing me and for inviting me in participation. It's as usual, it's a big pleasure for me to participate in Global Forecasting School. So a quick plan for today that I would like to cover. First of all, I would like to recap higher for longer concept about future path of interest rates. At the second stage, I would like to cover implications of this higher for longer concept for the public debt sustainability. And very related to the second topic is the notion of fiscal dominance. And we will discuss a couple of papers that I selected, and they are quite relevant for the fourth topic that I would like to cover also. This is the corridor theory that was more or less in detail described by Douglas, but I will introduce some quick recap of it also. And what I would like to cover today, apart from the corridor theory, is financial dominance concept and my research proposals that are connected to all the previous 5 topics. So let's begin a quick recap, but I think that you are all familiar with this idea of higher for longer interest rates and what are the key drivers that explain why there is a common understanding that interest rates can remain higher for a longer period than it was expected before. Just to quickly recap here, what matters is the strong demand, which can be explained by the wealth effect due to financial asset prices that more than doubled in the period beginning from the COVID crisis, and the increase in property prices. So these two major drivers that increase wealth of households and make demand stronger. Second driver is proposed regulation, and here the whole attention now, I think, in my opinion, is on the Trump proposals, and here these are across the board tariffs that are introduced in the program already, and more than 10% even for Chinese imported goods. And as usual practice, immigration measures and the deportation of unregistered workers and so on. These are labor shortages that can be a consequence of it. And of course, these are pro-inflationary factors that could lead to higher interest rates that should be remain due to Taylor principle and so forth. But apart from those regulations, also large-scale infrastructure spending, and this is not only that is related to proposed regulation by Trump. Actually has already implemented during Biden's administration. So large-scale in infrastructure spending, they are already in motion, but even more is proposed. And apart from that, tax cuts. Of course, tax cuts can be regarded as a stimulus for economy, so increasing economic activity, and this is also a pro-inflationary factor. What also important here is the understanding how the neutral rate would behave, and are there any revisions of this neutral rate? Because neutral rate is a key policy measure that is a basis of monetary policy. Because what regarded as restrictive or stimulative monetary policy is based on where central bank estimates the neutral rate. And here, during all discussions that we were before, they were made several very important things that correspond to the higher neutral rate. These are market revisions that we see now, and here neutral rate is estimated from the financial data that we observe, not from the fundamental modeling perspective, from the general equilibrium, but what market thinks where this neutral rate should be. And here we can see the divergence about what the Fed thinks about neutral rate and what market estimates as a long run level of the yield curve can be regarded as this market estimate of neutral rate. And also several important things that were stated by Charles Goodhart during his when he was participating. And we already said about increases in wealth and robust economic activity. This is what was said by Goodhart, but not only by him, even representatives of Fed, they also note that robust economic activity and housing market resilience, these are factors that actually make it very difficult to estimate the level of the precise level of the neutral rate today. So as I said, neutral rate is a modeling exercise. So we can estimate it. We do not observe it from the data explicitly. So it is something unobservable, something abstract, and we need to understand how to estimate it. And there are many ways, yeah, and many factors would affect this level of neutral rate. So as I said, very difficult exercise, and even representatives of Federal Reserve, they make a hint that maybe neutral rate is even higher than we thought before. So this is corresponding to revisions of the neutral rate. And also there are some fundamental factors that drive neutral rate on the long-term perspective. And here, what's important to notice is the work by Goodhart and Pradhan from 2017, and they elaborate topic of demographic changes, how it affects this demographic reverse, how it will affect the neutral rate. And they arrive to conclusion that despite the common knowledge or common hypothesis that demographic change would drive neutral rate lower, they found quite the opposite effects, that it can lead to even higher neutral rate. But what matters here is not only higher for longer concept itself. What matters is the implications of this higher for longer environment for public debt sustainability. And here, again, a quick recap what was discussed during previous sessions is the understanding how term premium would behave in the following years. And now term premium is quite low. But what happens if it returns, for example, to its historical average, that is around 1 percentage point? Then 1 year bond rate would increase from what is now 4.5 percentage points to 5.5 percentage points. And this is already matters, right? For how costs of debt maintaining increase, right? So if we have higher 10-year bond rate, it means that we need to provide higher yields for bonds that we issue as government in order to cover deficits. And this is only historical average, but during different historical episodes, this term premium was even higher, even 2 times higher. And that was what was happening after disinflation period, after these Volcker cuts during this period. It was disinflation, and interest rates, they were going crazy. And after this period of this volatility of interest rates, term premium was higher. And if we assume that term premium would return to this level, then the 10-year bond rate would increase even higher, up to around 6 percentage points. And 6 percentage points for as a cost of debt maintaining arises different questions and different issues, what we should do with it, right? So one of the like direct implication is that we need to transition from primary deficit to fiscal surplus in order to eliminate this debt expansion, because costs of this debt are becoming higher. But it can be very challenging, especially in a given current political climate. It is we can regard it as a pressure on the budget office. So it's a pressure on the fiscal authority in order to consolidate budget, in order to implement fiscal consolidation. But however, we can also assume that there exists another option. For example, the central bank can intervene in order to stabilize long-term interest rates, right? Through for example, operations that would resemble as quantitative easing, through these massive asset purchases, and that would drive asset prices, financial asset prices higher, right? Because central bank would propose extra demand for these assets, and that would drive these prices higher and lowering the yields. But this can be regarded as a pressure on central bank, because here I would like to rely on what Charles Goodhart was saying in the 6th of June, that political pressures on central bank, for example, to continue or to reintroduce it in order to cope with the bond market crisis. And the bond market crisis can be understood as these increasing yields, especially long-term yields. And these QE operations, they can undermine independence and credibility of the central banks. And we see that we have 2 options, but each of these options is in some respect bad. In one option, we can see a pressure on fiscal authority. In the second option, we see pressure on the central bank. And this situation, when due to debt sustainability, there is a interconnection of fiscal policy and monetary policy in the existing literature, is also described as fiscal dominance. And here I would like to rely on work by Kamphoff, which this work introduces the notion of this fiscal dominance, how to define it. And it is defined in this paper as a scenario where fiscal policy does not adjust sufficiently to ensure debt sustainability. So this is a situation when budget is not balanced. So when, for example, your fiscal authority would not increase taxes when spending is also increased. So it allows deficits. And this can be, many examples can be provided that would support this idea in the real practice. For example, poor tax collection systems, they can lead to this situation, or excessive spending can be also a reason for this regime, fiscal dominance regime. And basic intuition helps us to understand what would happen with inflation in this environment. And actually, inflation here serves as an instrument to remain this fiscal stability, because inflation would erode the real value of government liabilities. And this is the main problem that arises in fiscal dominance regime in many papers, that systemically you will have higher inflation. And inflation here serves as an instrument how to deal with that sustainability. And what this paper actually asks is whether in this environment, when we have fiscal dominance, in this environment, can monetary policy ensure price stability and fiscal solvency at the same time? And what are welfare implications of different monetary policy rules that can be implemented in this regime? So maybe, as many of you know already, there exists Taylor principle, which prescribes that the central bank would adjust interest rates if it sees that there is a deviation of inflation level from the target. And the idea is quite simple, that if inflation is higher than target, increase interest rates, and do vice versa if target is higher than the actual level of inflation. But this would happen in a Ricardian regime. It is a regime when a fiscal authority adjusts taxes to ensure long-term government solvency. But in the fiscal dominance, our intuition already says that high inflation would serve to erode this real value of debt. And inflation would work as an instrument to stabilize this debt. And in this regime, central bank must accommodate fiscal shocks, and it makes it not available to react aggressively to inflation, because central bank will think about what happens with the budget when it increases interest rates. So again, in brief, we can understand it as a special threshold that central bank faces in terms of interest rate, how he can how can he increase it. All right. So if there is a fiscal dominance, there is a threshold, and the central bank cannot increase it as much as it would like to, according to Taylor principle. But apart from this idea, there are several other important conclusions in this paper. For example, that, as I said, different monetary policy rules are studied there. And one of the crucial questions there was whether monetary policy, whether the central bank should react to different fiscal variables, for example, debt to GDP, whether we should adjust our Taylor principle and add there this budget, these fiscal variables. And the answer is quite simple and quite intuitive, that if we are under fiscal dominance regime, it's better to include than not to include. Another very simple idea is that if we compare from the welfare implications, one option is that we have fiscal dominance and we react to fiscal variables. And the second option, that we just do not allow fiscal dominance regime. The second option would be better. And this improvement of adding reaction of central bank to fiscal variables is minimal compared to the gains from eliminating fiscal dominance at all. So the crucial idea here is that fiscal dominance is bad, and fiscal discipline is crucial before committing to inflation targeting regime. Second paper that I would like also to highlight here is paper by the way, ECB, European Central Bank representative Schmidt, and this is a quite new paper that also studies two different regimes that are already familiar for us. So first regime in the previous work was called Ricardian regime. Here it's called orthodox regime. So maybe there are quite some differences, but they are slight. We can associate at least this orthodox regime with Ricardian regime that was introduced in a paper by Kaufman. And fiscally dominant regime. And what is important here, I would like to even cite the original text here, how the fiscally dominant regime is introduced. This is the central bank worried about the implications of high interest rates for fiscal stability, deviates from the conventional Taylor rule, and keeps the policy rate below some upper bound. That is when the economy is in the fiscally dominant regime. So we see again this notion of some upper bound that the central bank faces when he is worried about fiscal stability, about sustainability of debt. And what are the conclusions of this paper? There are the following. And one of them is that under fiscal dominance, inflation is systemically higher compared to orthodox regime. What is orthodox regime here? Is well, very simple idea is that monetary policy focuses on its price stability goal and sets the policy rate according to conventional Taylor rule. And at the same time, government takes care about government debt sustainability. So this is not a goal for central bank. These are goals that are separated between fiscal authority and monetary authority. And in a fiscally dominant regime, it can be also understood that the monetary authority thinks about what the fiscal authority in the first best should think of. And this systemically higher inflation is basically what was already mentioned as a basic intuition. That again, here we see that this fiscally dominant regime is realized in systemically higher inflation. But apart from that, as you might understand, that systemically higher inflation cannot happen when there are not systemically higher inflation expectations. They work in the same direction. But here, inflation expectations matters also because it creates vicious cycle, how it was introduced in the paper. And what is the vicious cycle here? If there is a pressure from the perspective of debt sustainability, it means that the central bank would not be able to increase rates higher as it would like according to Taylor principle. And it means that inflation would be higher. And again, so this circle can be understood a bit maybe more simple, even put it this way. You have higher inflation expectations because what your rational agents here understand is that the probability of shift to this fiscally dominant regime is higher if you have problems with that. If this probability of shift to this fiscally dominant regime is higher, then it would drive your inflation expectations, right? Because in the fiscally dominant regime, you would have higher inflation. And if your inflation expectations are higher now, it means that the central bank, in the ideal world, should react already by raising interest rates. And if this increase in interest rates required already right now, it creates even more problems with your debt sustainability. So again, we go circles from debt sustainability to debt sustainability through these inflation expectations and probability of shift to fiscally dominant regime. And one of the implications of these results is that from the welfare implications, it is better in this environment to react less aggressively for central bank to inflation. Because if he would react more aggressively, then it would increase risks of fiscal instability that would drive us to this fiscally dominant regime and higher inflation. And so even a bit very interesting result. So reactive. If you react more aggressively in order to cope with inflation, you will drive up inflation expectations because agents there they are rational and they understand that increased interest rates would result in higher debt and sustainability. So again, we see that endogenously it is optimal for central bank not to react that aggressively. And to summarize this idea of fiscal dominance, it is also crucial to understand the corridor theory and briefly recap the main, the core ideas that are underlying this theory. Basically, idea of corridor means that there is a lower bound, and this theory combines two major major notions that were discussed in the literature about effective lower bound. Well, this is well-known idea, and for quite a long time already, that it exists, and it restricts monetary authority from decreasing interest rates infinitely below some maybe a zero level. It would be a zero lower bound, but it can be a bit higher or a bit lower. This is effective lower bound. And we will not discuss what fundamentally drives this precise level of effective lower bound, but it exists. That there is some level from below that you cannot. It's not a good idea to set interest rates below this level. And also this upper bound, as it was discussed before, due to this debt sustainability issue, you cannot increase interest rates high as much as you want, right? Because it would bring some risks for fiscal sustainability. But what theory says is that when you reach these bounds, it doesn't matter. If you reach the lower bound, there is a risk of financial instability. And even if you're close to upper bound, there arises issue of financial instability due to debts, due to fiscal unsustainability. So financial sustainability, financial instability here is regarded as a consequence of fiscal instability. And what I would like to introduce is to regard this financial instability not only as a consequence of fiscal instability. And here we can arrive to idea of financial dominance. So again, this is a supporting idea for the corridor theory, but it just elaborates another channel how increase in interest rate could undermine financial stability. And here, what is important to understand here is whether this notion even exists in the literature, financial dominance. So for now, we already understand what is a fiscal dominance, that you cannot increase interest rates as much as you want because it would drive costs of debt, and debt sustainability here restricts you from that. But financial dominance is a little bit different. The core idea here is that it would threaten the stability of the financial system. So basically, these are banks, and something bad would happen with banks. And as I said, this idea of financial dominance is it's not completely new in the literature. So there already exist some papers that that elaborate this idea of financial dominance. And the main idea here that is presented in many different papers is that this is the situation when the financial sector is not able to absorb losses. So what is important to understand is that these are banks here that actually produce risks. They are taking risks when when we increase interest rates, and these are losses that these banks would have on their balance sheets when the interest rates are increased. And I mean, this is not a theoretical concept. So last year, in the United States, there was a banking crisis, and I would like to discuss some illustrative pictures that describe what was happening during this time. One picture shows us how the yield curve changed in a comparably short period. So you see that the blue line is the yield curve that was in May 2021. Red line is a yield curve that was observed 2 years later. So this is basically the horizon of 2 years. We can see that in May 2021, the yield curve on the horizon of 2 years was, I mean, it was close to zero. So during this period, there was a kind of expectation that this lower interest rate would remain in the future. I understand that yield curve does not fully represent expectations of a future interest path, because yield curve also incorporates term premium and other risk premium and so forth. But what is the underlying idea under yield curve? It should be expectations, right? About what would be the expected path for interest rates and yields. And what happens is that this yield curve changes dramatically in these following 2 years. So what it means basically from the basic economic intuition that expectations were wrong, it means that the actual interest rate paths change dramatically. And basic economic intuition says that when you have bad forecasts as a financial, for example, as a firm or even as a household, you will have losses. This is the basic intuition under bad forecasts. And this is why I think global forecast school is made for, in order to make good forecasts, right? And I mean, this is not only basic intuition about losses. This is what actually happened. So we can see on the right-hand side the unrealized losses on investment securities that appeared on banks' balance sheet. So this is a remarkable level of unrealized losses, and I mean, this is historically remarkable. So we need to study it. I mean, in details. It is a historical episode. And why these losses they happened in this time? Due to a very simple idea that the price of these investment assets, investment securities, decreased when interest rates started to increase. So they have inverse relationship, and it is quite understandable. If you have bonds on your balance sheet as an asset, their price will decrease when interest rates go higher. There is a direct reverse relationship. Yields are inverse compared to prices. That's it. So if you keep on your balance sheet bonds and other investment securities that behave in a similar manner in terms of prices, then you will have losses. But why they are called unrealized? Because you do not realize them at the moment, actually. So yes, you have on balance sheet some assets that now their value now is lower. So in principle, you have losses, but you didn't sell them. So you haven't sold them at the moment. And this is why they are called unrealized. But you can imagine that these unrealized losses, there is a one step that you need to make in order to create realized losses. You need to sell them. And this is what actually happened during this banking crisis. Some banks, they needed to sell them in order to cover their liquidity issues. And the second remarkable observation here that is related to US banking system is the deposit outflow. It was already introduced in the literature, deposit channel of monetary policy, that when you increase interest rates, there is an outflow of deposits from the banking system. But in the history before, we didn't actually observe that massive outflow. So this deposit channel, in theory, was elaborated as that one potential channel how monetary policy can affect the real sector through an increase in interest rates. But in 2023, there was a massive deposit outflow. It was remarkable. It was around $1 trillion compared to 27 trillion as a US GDP. You can understand that it is a very substantial number. So yeah, it really happened, and it created problems for banks, because they need, when you face as a bank deposit outflow, it means that you are facing deposit withdrawals, and it means that in a moment you have liquidity issues. So you need to attract this liquidity from somewhere. One way you can sell assets, and this is what SVB and First Republic Bank, but mostly SVB, were doing. they were selling their bonds, they were selling these long-term securities that they were having on their balance sheets. And this created losses, and it actually exacerbated these deposit withdrawals, because your depositors observe that you are now having real losses on your balance sheet. Then the confidence in keeping deposits in this bank is even lower, and this is a vicious circle, vicious cycle again. So some highlights to recap what was happening during this financial crisis is these massive unrealized losses that became realized losses for some banks that were having liquidity issues. In order to cover their liquidity needs, they needed to sell these assets, and that made unrealized losses real. Of course, it was higher. This was more pronounced in banks that had not adequately hedged their interest rate risk. But again, when you see that the yield curve is around zero in the following 3 years, it creates risks for your estimates of what is the real value of interest rate risk that you need to cover. This is, it makes you it makes it difficult to estimate how much hedge and what is the price of this hedge that we need to keep. Another illustrative situation here is that these deposit withdrawals that we already covered, and actually there were some underlying risks under deposits that were held in the banking system at the moment. Then is the high amount of uninsured deposits. So basically, there's deposits that you do not expect that bank will return you if it collapses. These are uninsured deposits, and of course, if you have a huge share of these uninsured deposits, it makes the deposit base of banking system very hot in terms of it would react very quickly if the situation changes. And of course, this behavior of yield seeking, when interest rates are increased and increased quite quickly, that would stimulate depositors to find some alternatives to bank deposits. And this also creates these incentives to withdraw a deposit and to buy an asset, for example, that can provide you yields that are higher than the interest rate on your deposits. And also what I'd like to highlight is the concept of forward misguidance. Of course, it's not understood as this yield curve, because forward guidance is something else. It's about how central bank communicates what's going to happen and communicates the future path of interest rates, for example. But yield curve here is also important in terms of what were agents actually expecting at this particular moment. And what Eddie Brander during our discussion said is that QE and other mechanisms to keep long-term interest rates low were misguiding policymakers to think that the expansionary fiscal policies can persist forever. So actually, this is very close to this idea that when you keep interest rates low, especially long-term, it is misguiding in some sense. And the final part of my speech for today, these are my research proposals that I would like to announce today. And the first one is based on a paper by Laxton, by Bennis and Kamphoff, and actually they have two papers. One of them is more theory-based, so this elaborates the prototype model, and another one elaborates different simulations and in different scenarios how this model performs. And actually, what I find interesting to study based on this model is the introduction of bonds as an asset on bank balance sheets, because it would allow to replicate this picture of losses for banks. And due to very simple mechanisms that increase in interest rate would decrease bonds value. These are not only, these are, I mean, bonds here can be understood a bit abstract. So these are not precisely government bonds. This is something that is close to the bonds in terms of behavior of prices of these assets. And an increase in interest rate would decrease this bonds value, and finally, it would lead to losses of banks, and finally, bank capital erosion. And model that was presented in these papers, I mean, it's very good. And for me, it seems like this very simple introduction will not change the whole ideology of this model. It would just let us study this particular channel through the decrease in bonds value. Again, this is going to be a supportive idea for financial dominance and supportive idea for the corridor theory. But here, what this approach tells us, this approach answers the following question: who keeps bonds? Who keeps this debt? And this approach answers is that these are banks who keep it on their balance sheet, and this creates losses when interest rates are increased. The second approach that is also possible to introduce is that bonds are kept actually by households. And maybe not particularly households, maybe some money market funds that actually are present in US banking system. And actually the deposit outflow that was observed in US banking system, it was aligned with the corresponding increase of money in these money market funds. So actually, people were withdrawing their funds from banks, and they were used in these money market funds. And these money market funds, they follow this very simple strategy, business strategy. They invest in short-term debt. So actually, they are you bring the money, and they use this money in order to buy some debt, short-term debt, and they are able to provide you yields that are comparable to short-term money market yields, yields that correspond to, for example, 3 months treasuries. And banks cannot do that. Banks provide you deposit interest rates that are actually lower. Even if they understand that there is a risk of deposit outflow, they still represent sticky rates behavior. It means that there appears a spread of short-term yields that you actually can get if you invest in short-term debt instruments. And the spread between these yields and deposit interest rates that banks provide, this is what's called sticky rates behavior. And this in turn creates this deposit outflow from the system, because now if households decide how they want to keep their money, they would change from deposits to these money market funds. And again, we can create here and replicate the following the following chain of consequences. Increased interest rate would lead to deposit outflows. This could lead to two options, basically. Asset sales that was actually happening during the SVB collapse and during this banking crisis in the US. Or it would require banks to attract liquidity from the money market. So actually here, proposition is a bit more tricky. So in ideal world, we would need to introduce money market in this model. And through this money market and through this liquidity issue and increased costs that banks face during this capital withdrawal, during these deposit outflows, we arrive to bank capital erosion through losses on this increased funding of banks for their operations. So basically now in this basic setup of this Laxton, Bennis, and Camfo model, there are no bonds in a budget constraint. So maybe we just can introduce them and see what would happen when interest rates are increased, whether we are able to replicate this deposit outflow behavior. And last but not least, the third proposal is about overlapping generations and to study fiscal dominance in OLG setting. This is OLG setting is not new, and OLG in context of monetary policy is not new. There exists a paper of Gali, and it is quite new, from 2029. There, OLG models were used in order to study asset price bubbles in equilibrium. Why even overlapping generations? Why it would be it can be supposed as a good idea? Actually, these OLG models they can represent non-Ricardian framework. So if we consider, for example, infinite horizon models where agents maximize their utility on the infinite horizon perspective, that would lead to so-called Barrow-Ricardo equivalence. It would mean that increase in government spending would understood as an increase in a corresponding increase in taxes later. So actually, agents already incorporate that in their decisions. But when agents lead for a finite horizon, it can change the logic of macroeconomic dynamics here. And also it allows us to represent the real world more accurately, because in some sense, we are indeed overlapping generations with some intergenerational connections, but however, we are generations. Maybe it would provide us some very important insights, and in particular, some distributional effects for different generations and how intertemporal budget constraints there perform. And of course, if we are interested in long-term effects of fiscal policy and the issue of sustainability of public debt, here OLG setting can be very promising. Here I would like to end my research proposal sections, and I'm ready to answer all your questions. Thank you for your attention.
Fantastic. Thank you. Thank you very much, Timur. It's been a really, really great presentation, especially when we are discussing, the monetary policy, for example. We usually obviously think about the effective lower bound and the potential consequences, but we need to understand that the central banks might actually face constraints that are actually more serious in their effects. So obviously, thank you. Your presentations, as always, produce a big added value to what we are doing at the Global Forecasting School. And we have exactly 9 minutes for questions from the audience before we move on to another part of our live stream, another part of our panel discussion. So does anyone have any questions to Timur?
Can I jump in now?
Yeah, absolutely. Please,
Yeah, sure.
Go on, Miriam.
Firstly, I just saw that Diana has also raised her hand, so I'll be quick. Maybe it was very interesting, Timur. Thank you very much. And while we were speaking all of these issues and discussing this, I was thinking about the current stance, right? Maybe we are exactly in the period where we are after this monetary dominance period. Before this, during this moderation period, we had definitely this monetary dominance, and now maybe we are exactly facing these fiscal dominance problems, right? That's in this context, maybe this is very important to discuss these issues, and maybe just we can hear your views about this as well. Like, while you have this fiscal driven inflation environment, just rising rates so much could even be harsher for us, and especially creating some sort of credit crunch, for example. That was also one of the biggest issues that we used to discuss, especially during 2023. It seems like that we are kind of hitting now the not the source of inflation, but we have another sacrifice here. And by doing this, maybe we are exactly just exacerbating this problem because of this nature of countercyclicity of fiscal policy, right? So in this regard, maybe it's also interesting to hear your views. How would you just evaluate or assess the current policy of Fed? Do you believe that they are taking this into account and they are also trying to deal with this issue that this fiscal-driven inflation, which would be for them, could be for them a big pressure over time? If fiscal policy will not be relevant, if we will not see some sort of fiscal consolidation, as you said as well. I would add here that given what you see, for example, over the projection, like it's obvious that this fiscal burden is increasing over time. And if the Fed will not just start normalization, I mean, reducing cuts, it could be even further it could be even bigger burden for them, and we would end up even in an environment where inflation will never converge to the target. So, what's your view about this? How do you think?
Yeah, thank you for such a fantastic question, and the question / comment, right? About the Fed. Well, I didn't work in the Fed. I worked in another central bank. So I am not a representative in order to explain explicitly what they think and what they want to do and what they consider. But we can, but we still can make some considerations according to their official communication, what is published. And here, I think that the Fed is not the only example. This is a very sharp question for any central bank. I don't think that any of them would admit the existence of a fiscally dominant regime, that they would admit it. It is a very painful piece of signal, right, for the public, that we are now really considering it. So I do not think that they would make it explicit. But
For sure.
whether they take it into consideration, like in their internal basis, I think that yes, probably. If it wouldn't be such an important issue, we wouldn't discuss it here. I mean, this issue of fiscal dominance is getting attention more and more in the academic literature and in in financial sector also. So people are starting to use this notion more frequently. And it means that people are starting to think about it, what actually drives and what actually restricts monetary policy from increasing interest rates. Yeah, so maybe I cover
Yeah,
a bit.
for sure. I didn't mean that they would be explicit in this regard, for sure. And no, a monetary policy cannot be explicit in this regard because it's because of the independence at first, right? The central bank should be independent and following this rule. So just I get your response fully. Just my concern is that maybe over the time, depending on the political situation, this type of risk will further exacerbate from my perspectives. And the idea that we will see this budget surpluses over time, then big fiscal consolidation seem less and less probable from my perspective. So that's rising concern, and I assume that we are now in the era of fiscal dominance. But for sure, monetary policy makers will not be explicit in this regard. Yeah, that was like a short comment from me. Thank you for a very interesting presentation, and maybe others could have the questions as well.
Diana?
Thank you, Timurjan and Mariamjan. It was very interesting to listen to you. So my question is like this. Usually we communicate that fiscal dominance is some monster that can kill the monetary policy tools or even make some bad environments for the economy. So I wanted to understand, are we smarter than US government, that or there is some reason that we didn't take into account, and maybe there is some part that can be even helpful for US and even for monetary policy, because we know that in any time when US can create a money, it can be involved by the global economy as well. So my question is like this, Timur, do you have some judgments about it or not? Or you think that it's some monster that will kill the economy in the end?
Thank you. So basically, there were two questions. First one, as far as I understand, are we in a better environment, or are we smarter than the Fed in terms of this fiscally dominant regime or not? Here, I would answer it the following way. I think that it's not productive and it's not efficient to think that anyone is smarter than the other guy. I think that the most productive way is that see mistakes or see risks that are present in other economies and do not replicate those mistakes in your economy. So in this, so answering it like that, I would like to underline that it is very important to study whether this fiscally dominant regime or takes place, or whether the central bank is close to it in different economies, and and study what are the implications for the real economy once you are close to it, or even if you reached it, in order to not to make the similar mistakes in your turn. And times are changing, right? So I mean, it is very easily to imagine how you can get to fiscally dominant regime, increase spending, or due to any circumstances when you need to increase spending, and you are now closer to fiscally dominant regime. And that's it. So the core idea here is to study and study. The second question was about whether fiscal dominance would kill monetary policy in the end. I would regard fiscal dominance not as a death of monetary policy. It's just another regime of your policy. So it is just a regime that is described as that the central bank now pays attention to debt sustainability, and actually it can try to stabilize prices at the same time thinking about debt sustainability, although it would the central bank would perform much worse than compared to environment when you do not have fiscal dominance. So this is about the inflation in the end, not the death of the monetary policy, not the death of economy, about the outcome. And for us, inflation takes the first place here. So what we know from theoretical perspective already, that inflation in these circumstances, the inflationary outcome would be higher compared to where you do not have fiscal dominant regime. So this is not a death. It's just the comparison of outcomes.
Perfect. Thank you. Thank you very much, Timur. Unfortunately, we do not have any more time to entertain any other questions. However, I'm sure that the topic is very interesting and worth exploring in the future. So thank you once again. And now we will be passing.
Thank you.
And now we'll be
maybe
moving on.
I just want to make a point,
Yes, sure.
because the way you told the story, Timur, which was perfectly okay, but you focused on the banks holding treasuries and so on. They could also hold mortgages. Like during COVID, some of the banks lent money to people, 30-year mortgages. I actually remember the exact number because I just thought how ridiculous holding, putting on your balance sheet 30-year mortgage rates under 3%, like below 2.9, down to 2.8. Okay, and And the other point of your story is that you have these unrealized losses when interest rates go up. You didn't really mention that it's really non-linear, that when you discount things by the interest rate, the closer the interest rate gets to zero, the more the capital losses can explode with higher interest rates. And the second thing is that you made it sound like that it's only when you realize the losses that bad things can happen. But actually, the bank's share prices, so the potential unrealized losses will be capitalized into the share prices of the banks. And so the big problem there is that when those share prices are low, they're not going to want to go to the market to raise capital and so on. So you have this potential. So I just wanted to say it's not just when you realize the losses. It's when the banks come under stress and their equity prices fall. It can be under extreme stress where they have to sell it to get liquidity. But that's more of I think, you can still analyze what the vulnerabilities are simply by looking at the share prices of banks and how they're factoring in perceptions of losses on their loan portfolio and their securities portfolio. But they're just a minor comment in terms of how you told the story.
Thank you very much.
I liked it very, very much, and I look forward to all the research you're going to do. Actually, modeling the stuff in a framework that has some heterogeneity and so on. So that paper by Jaromir Benish and Michael Kumanov and I was kind of dead on arrival in the sense that we had no way to extend the model to make it general enough that the model could be applied to many different country situations. You just don't have enough heterogeneity in the infinite horizon representative agent model to do that. But it was, we did get a calibration where we got sensible results to explain the seeds of financial crises and what kind of nasty, vicious interactions we could get between balance sheets of banks and the balance sheets of households or businesses and asset prices in the real economy. So those interactions can become quite nasty. And we showed that with a couple of non-linearities that we can explain financial cycles. In other words, both the expansion phase of financial cycles and the boom and the bust and so on. So thank you very much. Alex, I think we're now turning to the GFS students. So can you please maybe start the next session?
Yes, of course. Thank you. Thank you once again, Timur. Thank you all the people, Mariam, Tiana, who asked questions, Dag, for your comments. And now we'll be moving towards the second part of our discussion, which will give floor to the GFS students who will discuss the intricacies of their analysis using the scenario approach of the US economy. But first of all, I would like to pass the floor to Dag, who is the founder of the GFS, or the instructor at the GFS, the founder of the Better Policy Project, to share his insights with us. So please, welcome, Dag.
So I don't know if his nurse is online. He was called away to an important meeting, but he'll be joining us, okay? He was the deputy governor responsible for monetary policy when I first came to Armenia in 2011. And I would say many of the things that we're incorporating into the dynamic learning environment in the global forecasting school, little quotes like fail fail again, fail better. His attitude that if you're going to train people, you have to put them into an environment where they're not afraid to fail, so that they can learn as rapidly as possible. Ideas like global engagement and collaboration, in this case between Georgia and Armenia, allows us to exploit synergies, but also to develop a critical mass of resources that will allow us to compete globally in terms of doing research on modeling and so on. Okay, so a true visionary. So he'll be popping in and he'll be listening to what we're going to be doing here. We're going to play this game called Hawks and Doves. Okay, in Armenia, we have a board system where the individual board members are accountable. And so in the design of the system for Armenia, we don't think in terms of hawks and doves. We don't want the staff to think in those terms. Their job is to provide all the information to the board, allowing the board to make the decisions about monetary policy, because they are the ones that are responsible for monetary policy. In other institutional frameworks like Georgia, where we have a governor decision maker model, historically in some of those central banks like Georgia, they tried to get consensus seeking among the staff, and in many cases they would create a monetary policy committee that would not have any legal obligations and so on, but just through tradition, the belief in consensus seeking, that you're trying to develop the institution. So we thought that it would be fun to play a game where we got everybody to think like a governor, to think about implementing a least regrets policy, or what we call the prudent risk management approach to monetary policy, because we thought it might be a good training exercise. Now, our economists, we don't want to be hawks, and we don't want them to be doves. We want them to understand the arguments for doves and for hawks, and we want them to be able to present both sides of those arguments. And so on. So this game that we're playing here is partly to see if we can learn something about how this might be applied in a governor decision maker kind of framework, but also just because we thought it would be good for the students to get inside the heads of what a real policymaker is, where they have preferences. So that's really what the hawks and the doves are about. It assumes not only that you can reach an understanding about how you think about the economy, but what your preferences are in terms of managing big risks and avoiding dark corners and so on. So I want everybody to understand that this is an academic exercise, but I think it's one that we'll end up keeping, because from the results that I've seen, I like the fact that it's getting everybody thinking. So on that note, I'll turn it over to our two senior GFS students, Miriam and Leah. They have organized the students. I'm not sure exactly how, but please proceed, Miriam and Leah.
Thanks, Doug. Thanks for a very interesting introduction. Basically, as Doug said, Leah and me kind of organized this session. And just let me briefly introduce the rules and kind of the motives, what we are doing here. And then we will have our keynote speaker into the session, which will be Ani. And then Leah Jen will proceed for sure. So basically what we are doing here, guys, is that we are wrapping up our week, which was a very interesting week. mostly because of the FOMC decision from yesterday. We all know that the Fed kept unchanged its policy rate, and the motive of this week for us was that to kind of consider all sorts of considerations for U.S. economy and to provide our arguments from FPAS Mark II perspectives, what would be better policy decision and how we would kind of assess our decision based on this prudent risk management approach. We all more or less knew that it was anticipated what Fed did, because just keeping the policy rate unchanged. For all of us, the key interest was that what kind of communication they would have. And it's kind of continuation of the previous communication, I guess, because we still see some sort of hint that maybe we should expect some policy rate cut in September FOMC meeting if the upcoming data will give them the ability to do this. And it's very interesting time, I guess. And that's why we at the GFS, we are focusing on US economy. During this week, all GFS students delivered presentations and provided, as I said, their arguments. And we look at this process as a very valuable learning experience. And to wrap up all of this session, we've decided just to choose one of our students' presentation, Ani Asoyan, and she will deliver her presentation about US economy development. And after this, we will give floor to our GFS students to provide their arguments and their comments, asking questions to Ani as well, for sure. How do they look to the current development in the United States, and also during this process, to make it more interesting, we will assign them the roles. So they should provide their arguments based on the role they will have. Are they more dovish policymaker, or would they lean to more hawkish stance? So from this perspective, they should provide their views. So I guess this will be very interesting because they don't know, the GFS students don't know exactly now what kind of role they will have. So it's like dynamic environment, and we will see how we will just deal with these issues and if we pass or not. But let's just start the game. And I would like to ask Ani just deliver her presentation, and I would just ask all other students to listen very carefully to her. Okay, thanks all of you, and Ani, please, the floor is yours.
Thanks, Mariamjan. I'm very excited to share my views and analysis upon the US economy and provide future probable scenarios. Let me share my screen. Sorry, so this one. Okay, so first, I think that you are all already well aware of the FPAS Mark II, but still I think that it's never enough to emphasize the importance of the FPAS Mark II and talk about it. So this approach of providing future probable scenarios, it comes from the newly established system, FPAS system, that Central Bank of Armenia has begun utilizing since the beginning of this year. And if we compare it to the previous framework, which was called the FPAS Mark I, the policymakers were mainly focused on the one scenario, which was called baseline scenario, and it has its own drawbacks in terms of uncertainties. So recently, as we see, after COVID pandemic has hit the economies, also current geopolitical tensions, they generate uncertainties in the world, and this uncertainty has become kind of inherent, so we cannot eliminate it, but we can generate probable future scenarios to address risks and uncertainties that come from different angles of the economy. So problem of only having one baseline can be this folly can be that it provides some false sense of assurance to public and also financial market as well, and they might ignore other significant risks related to the future scenarios, and also it might restrict policymaker in their decision making. So monetary policy might not be flexible enough in that case. So here in this new framework, we consider these case A and case B scenarios and also market reference scenario, which acts like a benchmark for them, and it incorporates market expectations into that. So contrary to that, case A reflects future economic and financial developments which require higher interest rate path than what is currently priced in financial markets, and contrary to that, case B requires lower interest rate path. So we also have two additional case X and case Y scenarios for the tough times. Those are the extreme scenarios or the so-called dark corners of the economy, which require way more hawkish or dovish policy actions than case A and case B type scenarios. So during constructing these scenarios, we keep in mind these three ingredients, and we ask ourselves these questions. First is where is the economy now, which refers analyzing the current stance of the economy. Next one is what do we think might be driving it. So this is acknowledging the prominent prominent transmission mechanisms and features of the economy. And the last one, which is the most important one, refers to acknowledging and understanding how we should adjust our instruments in order to achieve our objectives. So this refers to the third principle of monetary policy, according to which central bank needs to adjust its instruments, which usually happen to be the interest rates, sufficiently aggressively to set a nominal anchor. So in terms of Fed's policy, we know that Fed has dual mandate. It's the maximum employment and price stability. And so it needs to adjust its instruments sufficiently aggressively to achieve its dual mandate. And if it fails to do so, then it will lose credibility, and it will become harder for Fed to do policy in terms of higher sacrifice ratio and higher disinflation cost. So these failures of policy we often see in case of non-FPAS central banks, such as Bank of Brazil, Bank of England, and so on. And they lack these three ingredients of FPAS, and upon which they do not consider scenario analysis, and they do not weight these scenarios and risks, and this will not lead to this policy which is called least regrets policy. So this least regrets policy is basically the minimization of losses that FPAS Mark II central banks will do. So they also lack accountability in terms of transparency, and this lack of accountability usually leads to policy actions related to elevated economics. They might provide just data without underlying context, or they might ignore the interconnection between variables and so on. So some of them are not independent. Some of these non-FPAS central banks are not independent to begin with. For example, Bank of Brazil has just got its independence in 2021, but still there are some political turmoils which restricts the central bank to conduct policy which is consistent with its objectives. So this restriction, as Timur has already talked about, can be described by this interest corridor theory, and this is the defined range of the interest rates within central bank might be constrained to operate its monetary policy, and within the upper bound it is constrained by the fiscal dominance, and in the lower bound it is constrained by effective lower bound. And I want to describe this effective lower bound with a real life example. So coming from the pandemic events, we saw that it can provide a definite real-life example of the effective lower bound. As we saw for many countries, many central banks, including Fed itself, has cut the interest rate very low, around zero. And so this is the effective lower bound, where the interest rate differs from zero by negligible amount. And so they were unable to cut the interest rate further to stimulate the economy. And as an aftermath, they shifted to unconventional measures, unconventional policies, such as quantitative easing, buying or selling government bonds, and so on. And if you look at the US data, we can see that this case was carried out by the fiscal expansion together with monetary easing. So during June 2024, we had a national debt of approximately more than $34 trillion. And if we compare this number with the previous period of the last year, it has had a massive increase, almost more than $3 trillion. And looking at the M2 dynamics, which contains both cash and deposits, we can see that M2, the measure of money, it has also this increasing dynamics during these events. So this reflects this increasing precautionary savings which accumulated during both this fiscal expansion and monetary easing. So this influx of savings into financial markets drove up the prices of assets, both in terms of financial assets and non-financial assets. Looking at this S&P 500 index, we can see it has almost doubled compared to pre-pandemic period, and also non-financial assets have been drawn up as well by around 50% compared to the pre-pandemic period. So these things happening in the asset markets have strengthened the household's balance sheet, and it resulted in an increase of around more than $45 trillion between the first quarter of 2020 and the last quarter of 2023. So for the recent data, I can say that it has increased by around $53 trillion. So it's a massive increase indeed. And this amount is more than double to the pre-pandemic GDP. So looking at the balance sheet decomposition, we can say that most of this increase comes from the financial assets. And this might create some fiscal sustainability issues in terms of higher term premium, and it will result in a higher borrowing costs. So this might slow down the economy, and it might create room for the case B type scenarios. Apart from that, this might raise concerns for the financial instabilities as well. So if we look at the real interest rate of the economy, and if this real interest rate becomes lower, if it remains below the economy's growth rate, that it might create some additional incentives for households' excessive borrowing. So because they might think and they might see that their collateral value has increased, and they might believe that their asset prices will go and increase further for the future as well. And they might this might create additional incentives for them to borrow excessively. But here I want to remind you this famous quote about irrational exuberance from Alan Greenspan, and this refers to the asset prices bubble. So if households borrow excessively, this excessive leverage can create some disturbances in the economy, and the economy might be vulnerable. And if there is a sudden collapse of assets because of this bubble, if the bubble bursts and there is a sudden downturn in the asset prices, then this will create financial instabilities, because borrowers might not be able to pay their interest obligations and their debt. And in the worst cases, this might create financial crisis. So this also creates room for the case B type considerations. But there is another perspective. On the other hand, there is a controversy about neutral rate being actually higher than what markets and Fed perceive it to be. So economists like Larry Summers suggest that this strong growth of the economy might indicate that there are some fundamentals, some supply side effects which drive these asset prices. And so this might not all be just a bubble, but it might also be the mix of the fundamentals and bubble as well. So Fed suggests that neutral rate should be neutral rate is currently 2.8%. And Summers suggests that it is actually higher. And financial market incorporates this thought of, partly incorporates this thought of neutral rate is higher than Fed perceives it to be, around 3.5%. And and these can indicate that Fed's effort to combat inflationary forces in the economy, mainly this tight labor market and this strong household balance sheet, might not be aggressive enough. So this might create a room for the case A type considerations here. And if we speak of consumption, we can see this strong balance sheet motivates households in terms of huge increase in the consumption. We can see that post-pandemic, not only consumption, real personal consumption expenditures have increased and they have come to their pre-pandemic level, but also they have further increased as well. And so as of the latest estimate provided by the Atlanta Fed for GDP now, we can see that it has increased from 2.6% to 2.8%. And looking at the contributions to that, we can see that services consumption is the main driving force of this increase, of this pent-up demand. So there is also a theory that households might actually shift from consuming goods to consuming services, but it is not. It has some questions in that in terms of interest rate channel, because this can be carried out by the thing that goods inflation might be more elastic to the changes of the interest rate, and so households might actually substitute goods for services. So as I said, the services consumption might be is the main driving force of this pent-up demand. But however, there are some uncertainties about whether this surge in the consumption will continue or not. So in regard of this stock market, I can bring one argument because, as I said, the stock market is mainly a bubble, as we estimate, as we observe, and this bubble is very vulnerable to the economic conditions, particularly the political conditions. For example, as recently we have observed when Joe Biden announced that that they will continue the economic war against China, we saw there was a sudden downturn in the asset prices. But then when Biden has announced that he will quit this political race, these asset prices have begun to increase again. So there is uncertainty incorporated these asset prices in terms of political things, and we do not know if when these asset prices will burst and if they will burst or not. And there is another argument. The second part of the argument comes from the savings. And so according to the IMF World Economic Outlook, which was published in April 2024, these excess precautionary savings, which have been accumulated during pandemic events, have almost been depleted. So these excess savings, they refer to these additional savings which have been accumulated during pandemic events because households were unable to consume their wealth that was being increased during pandemic, as we saw. And these might create implications on consumption, and so this might question the further increase in the consumption. So as we know with the numbers, as the World Economic Outlook suggests, almost 2.1 trillion US dollar excess savings have been depleted already. And so there is an uncertainty in case of consumption, and we incorporate this into the case B scenario in terms of the depletion of excess savings. So we consider that this will cool down the consumption and it will cool down the pent-up demand eventually. And so as I said, there is uncertainty that consumption will increase further, and this uncertainty continues to be in the labor market as well. And as there are some cooling signs in terms of the vacancy rate, which basically indicates the demand of the labor. Still we can see that unemployment rate increases, and so wages also incorporate these signs of cooling down of the labor market. We can see from the recent trends, looking at the average hourly earnings, we can see that there are some recent downward dynamics, but still it is way higher than the consumer price index, and it is actually higher than what it would be, which was what this level would be, which would be consistent with the underlying growth. So if you look at the Fed's estimate provided for the real GDP growth rate, it's around 1.8%, and combining this with 2% target, it's around 3.8%. And so wages continue to decrease, but this level of wages are still higher than this sustainable level of around 3.8%. So apart from that, there are some uncertainties regarding political case, and if we know that Trump is very resistant in case of immigration, and this Trump resistance to immigration might suggest that labor market might still remain tight, and this uncertainty is reflected in growing difference between payroll and also household service as well. So here we consider both scenarios, both case A and case B scenarios. And in terms of case A scenarios, we consider that market continues to be overheated. And in terms of case B scenarios, we see that there are some recent signs of labor market cooling down. So in terms of the financial side, we can see that credit conditions might tighten here, and we'll see that there are some tightening signs both in case of commercial and industrial loans and also credit card loans. And this might create credit crunch, and it might create incentives for households to not borrow so excessively, and this might actually restrict the demand. So this creates additional incentives for the case B type considerations. And overall, if you look at the inflation measures of both 3 months over 3 months and 12 months sticky price inflation, we can see that both of these series are on their decreasing path, but still they remain elevated compared to the 2% inflation target for Fed. And this decrease mainly comes from the flexible price inflation. We can see the commodity prices are recently declining, including wheat and corn prices, and also the oil prices are declining, but there are some controversies around it because oil prices are very, very vulnerable. But here I want to emphasize the importance of these underlying inflation, sticky price inflation, because these sticky prices are the 70% of the basket of the headline inflation, while the flexible prices are around 30%. And so these sticky price inflation, they indicate more fundamental and more domestic driven factors of the economy. So Fed should be very cautious in cutting their interest rate, and they should consider these underlying measures of underlying inflation. And despite that, we see some declining path here recently. We still can see that they are declining in a very slow manner, and they still remain elevated compared to their target. So these sticky prices I want to a little delve deep into these sticky prices, and I want to mention some indicators of these sticky prices. For example, the shelter costs inflation, the housing prices, which is part of the sticky prices. It's around 5.5%, and we see that it has decreased over the period recently, and from 8% from the March 2024, and right now it's around 5.5%. It's still very elevated compared to the 2% target. And also we can see that there are some cooling signs, and there, as we can see that Fed has provided this neutral rate to be 2.8%. Still, the interest rate might be actually higher than what Fed think it is. So I still want to emphasize the fact that and suggest that Fed needs to be very cautious in reducing the interest rate. And recently on Wednesday, I mean yesterday, Fed has decided to keep the interest rate stable, but they have communicated in a manner that they still these recent developments of cooling down of the economy, and they don't ignore these signs, and they don't also eliminate the possible future decrease in the interest rates. So markets also expect that Fed will decline the interest rate, and these expectations, the probability of the decline of the interest rates grows higher and higher over time. And so currently market expects this neutral rate to be around 3.4% to 3.5%. And basically, if you look at this market expectation provided by the Atlanta Fed's market probability tracker, we can see that market actually believes in the soft landing scenario. So they believe that Fed will eventually reduce the interest rates, and it will not harm the economy. So if I recap my scenarios under case A and case B type considerations, I want to mention first the higher neutral rate. That's theory come from the economists such as Larry Summers, and markets partially incorporate this theory into their considerations, into their expectations. So basically, it comes from the fact that the Fed's efforts to battle inflation for an extended period basically might not be aggressive enough because of the strong household balance sheets and also because of the overheated labor market. So they suggest that neutral rate might actually be higher than what we currently perceive it to be. And this might create K-safe type considerations. And the next one is the consumer fuel demand, which drives the economy currently due to the strong household balance sheet. And this is also connected to this higher neutral rate. So because of this strong demand and also because of this tight labor market, which is the third reason for the K-safe considerations, because of these two mainly driven reasons, they suggest that neutral rate might be high enough. And under case B type considerations, we can see that recently labor market shows some cooling signs in terms of vacancy rate. But here I want to remind you that still the unemployment rate is still below its Nauru level, and we do not have to ignore this fact, and we have to be very cautious in this regard. Another thing is the saving rates, which we saw that according to the IMF World Economic Outlook, they are coming back to the pre-pandemic levels, and basically more than 2.1 trillion US dollar excessive savings have been depleted. So it creates creates question about if this depletion of savings will lead to decreasing consumption or not. And the third reason which might restrict the demand is the tightening of the loan conditions. So we see there are some recent tightenings in the loan conditions, and the bank lending tightening has been happening, which might break this persistent strong demand currently that we see in the economy. And here I want to here I want to show you my illustrative scenarios. As I said, my market reference scenario incorporates these market expectations, and as they expect, I have incorporated the soft landing scenario into my Fed fund into my market reference scenario, where the Fed funds rate will decrease eventually and will come to the around 3.4-3.5% in the longer run. And along with that, we see that unemployment rate will eventually converge to the equilibrium level, which is around 4.3%. And looking at the inflation numbers, inflation measures for both year-on-year core PCE inflation and 3 months over 3 months core sticky prices inflation, we see that this soft landing is happening, and inflation, both measures are converging to 2% target eventually. And contrary to that, K-A type scenario, K-A type considerations create a room in which we see that unemployment rate might still be lower than the Nauru level, and this indicates these overheated labor market conditions. And this might actually require higher interest rate paths than what I have in my market reference scenario. And this will to combat this higher interest rate path is required to combat higher inflation, as we see from K-A considerations. And so in contrary to that, we can see that under case B type considerations, unemployment rate might actually be higher than the Nauru level. So I create a scenario where will come a time when unemployment rate will be higher than my Nauru level, and so this will actually undershoot inflation. So in under case B type scenario, we will have a little undershooting. So inflation will be below 2% target for a while, and after some time, in the longer run, it will eventually converge to 2% target as well. So this will require Fed to decrease the interest rate more sharply than what we expect, what markets expect currently. So considering these risks and considering these scenarios, I suggest that Fed should be cautious in reducing the interest rates. And I think that I support their decision that they had recently of keeping interest rates constant. And I think that they should keep the interest rates constant for a while and see what current what the future developments of market will require them to do. I'm not also ignoring the fact that for a while after September that they might need to decrease the interest rate, and but still currently we have to be cautious because still there are some underlying inflationary pressures in terms of tight labor market and strong household balance sheet that needs to be considered and needs not to be ignored. So that's it. Thank you for your attention. And if you have any questions, you are welcome to ask.
Thank you. Thank you, Anijan. So hello everyone. I'm Lia, and so again, if you have question, Anna. Okay, go ahead, then we can continue.
So I would like to ask you, like you've mentioned, like that Fed should be cautious about its like further steps, but still, to be more precise, how would you like rate yesterday Fed's action, and what do you think should be the following one in September?
Thank you for the question. As I have already told, I support their decision in keeping interest rates constant because we still, as we see, there are some cooling signs in the labor market, and also inflation is decreasing. Still, we can see that the underlying inflation is still elevated, and still labor market might be overheated. And so I also see that in September, I mean, I cannot say for sure, but I think that in September they still might be might have some incentives to keep the interest rates constant. So they need to be cautious to shifting this monetary easing cycle, because also I want to mention here that I am more of a hawkish person. And so I advise them to be very cautious in cutting their interest rates, because it's very easy to cut the interest rates because also market expects them to do so. And so communication with cutting the interest rate might be easier in this case. And because market also expects them to do so, then it will be easy for them to cut the interest rates. And this will be incorporated to market expectations. But still, they need to be cautious in their actions, and they might still have incentives to keep interest rates for a while. Thank you.
Thanks, Anijan. So let's start our game, and then everyone will have their time to give some questions. So thanks, Ani, and also, Mariam already mentioned about our game, but I just want to elaborate a bit more. I think one of the most important questions is, and it's a policy question, is which type of policy error might be worse for the Fed. So we need to understand that this is the essence of the least regrets policy. And another thing is that we need to understand the importance also of effective communication. So effective communication in policy decision must clearly state the main trade-offs for policymakers and also the types of risks they face, and when making some decisions, which type of word A or word B they believe is more probable and important. And also it should also clarify which risks are more costly and better to avoid. I believe this kind of argument will clearly explain the logic behind decisions and provide a better understanding of how policy decisions are made. So now we have our team members from Georgia, Armenia, Argentina, and so on. And our global forecasting school students will provide comments and act as either dovish or hawkish, let's say, governors. We will assign you roles and let's see how you will build your arguments and communicate your decisions. So let's start with Tamta from National Bank of Georgia. So dear Tamta, you will take on the dovish role. Can you communicate your thoughts? If you have any question or comments for Ani or in general, please feel free to ask, but keeping in mind that you are adopting a dovish stance. Also, before starting, I want to ask you not exceed 3 to 5 minutes maximum, so everyone can speak. Thanks, dear Tamta, the floor is yours.
Thanks, Leah. Challenge accepted. I don't like dovish policymakers. In reality, I'm the hawkish policymakers, but this is a challenge for me, and challenge is accepted. So firstly, thanks Annie for the nice presentation. So I have one question about your presentation, and then I will challenge your policy recommendation. So you were suggesting mostly to take the hawkish type of the policy makings, and I can challenge this approach as a dovish policymakers. Firstly, you mentioned about the China and the USA banning from USA to the China and potential the trade wars that could happen after the election, and this you were explaining in terms of the asset prices. And could you provide like the more insight about what will happen in terms of the real sector activity, how it affect if USA will ban China? What would happen in the real sectors and how it affects the real sector activity?
Thank you for this interesting question. So, firstly, I want to talk about the asset price uncertainty that I have already mentioned. And so this has this real sector, I have connected it with the asset prices basically, because I question the increase of the consumption further. And so I bring two kinds of arguments. Firstly is that we consider that most of the increase of these asset prices come from the bubble. And yeah, some of them has fundamentals. This is the neutral rate argument that we do not talk about here. And so most of this increase of the asset prices comes from the bubble. And so this bubble is very vulnerable to economic and financial developments, and also political developments as well. And I have already told, under different announcements, they might react to in different ways. So, for example, when Biden has announced that they will continue their economic war with China, then asset prices have decreased suddenly. And after that, when Biden has announced that he will quit the political race, they have increased again. So here we see that these dynamics of the asset prices is very vulnerable. And so in this matter, I question that will these asset prices will continue to rise or not, or will they suddenly burst or not? So this is the first part of the argument. And on the second part, I have mentioned that most of these excess savings which have accumulated during pandemic have already been depleted. So these both of these arguments refers to the consumption, and we say that if asset prices have sudden downturn, then households might not be wealthy enough to consume further. So this might create implications on consumption on the real economy in a way that it will decrease this pent-up demand, or it might restrict this pent-up demand. And this creates room for the case B type considerations. And this also the decrease of the the depletion of the excess savings also they support this argument as well, because most of these precautionary savings accumulated during pandemic events have been depleted, and there is no room for consumption to grow further. So both of these arguments were related to this real economic part, where we say that, where we imply that consumption might not grow further, and this might create room for the decrease of the pent-up demand that we currently are seeing. And so this is the case B type consideration.
Yeah. Thanks, Annie, for the clarification. So what I challenge and what I want to elaborate is that during your presentation, so you were explaining that what are the currently driver of the high consumption and the high real activity, and what we see right now is that the saving is depleted. So what could be driver for the consumption? First, this can be the saving. Second, this is like the credit activity, and third one is a fiscal stimulus. So in the first case, we already see that the saving is depleted, and there is a very high probability that this high consumption could not continue, and the saving could not fuel this high consumption. And also what we see during your presentation, we see that the lending tightness indicators is higher right now, and the credit activity is moderating, and that from this side, from the banking sector of the side, the consumption could not be fueled further in the future. So this is the second argument. Around the fiscal stimulus, I do agree that there is a very high uncertainty due to this election, and we don't know how the next president, what will be the approach of the next president. But also, anyway, what I think is that nevertheless, who will be the president, maybe his aim or her aim is to expand fiscal stimulus, but what you are thinking in advance is one, and what can you do after you will be elected as a president is the second one. So after the COVID-19, to have the fiscal buffer for further fiscal stimulus is very limited in USA and around the global, and I do think that nevertheless there would not be the big fiscal buffers to support the real economic activity, and we already saw there's some cooling down effect in the real economy. And the argument what I saw during this presentation, first one saving, second one credit tightness, and my perception about the fiscal stimulus support the arguments that the real sector activity will be lower than the market expects right now. So as policymakers, I'm more afraid that this cooling down effect is going could go the faster than we expect. And also I want to highlight the fact that, and also we see this cooling down effect in terms of the unemployment. And also I want to highlight one fact that when policymakers face like the inflationary period, after the inflationary period, so they are becoming the more hawkish, and they are afraid more inflationary, more than expected inflationary scenarios. But we, as a policymakers, we should be the proactive and should answer the questions and should react before the things start to happen. This was a policy mistakes and policy error during the COVID-19 and after COVID-19 period. We were the policymakers, we were quite sure that this inflationary will be the temporary, and they start Fed and ECB start to increase the interest rates, lag behind to start to increase the interest rate, because prior to this period we are stuck in the disinflationary period, and that's why they were more dovish policymakers. And right now I'm afraid that policymakers could make the same mistake, but on the other side. So that we face the inflationary period, and so we are more afraid about the inflation, and we are becoming the hawkish. Why we'll see that there is so many arguments about that the cooling down effect is going can go faster than the market expects right now, because the overview from your presentation and the arguments from the real sector activity and unemployment and the cooling down effect in the labor market supports the argument that real GDP growth will start to decline. And as a proactive policymakers, we should address this right now. Otherwise, we would end up that we can follow the more hawkish policy stance, and the economy is cooling down is going faster than expected, and the hawkish stance will push down these economic activities further, and we end up like the very low inflation and recession situation. So this is my arguments. I hope I did not exceeded my time limit. Sorry if I exceed.
Should I answer? Can I answer?
No, let's go and further, because we will have so much other questions and also views. And also thanks Tamta for your views, and it was so accurate. So now let's listen Gore. Gore is from the Global Forecasting School, and he's a participant in our summer school. So Gore, you will take a more hawkish stance. So can you give us some views, and also maybe you have some questions to Ani or someone else? The floor is yours, Gore.
Yeah, before going to the hockey scenario, I'll ask some specific question to Ani. So first of all, thanks for the presentation. It was really comprehensive one. And as you were introducing that the US economy is going more towards the service sector, you said that if goods prices are more elastic towards policy rates, people would substitute goods to services. But like conceptually, goods and services are different. So can you please elaborate more on that? So how could be they substitute towards each other, like goods and services?
I believe Mariam can help me in this question, because she is more of an expert of consumption. There is a theory suggested by World Economic Outlook that this might actually come from the substitution effect through this interest rate channel. As we know, the goods prices are more flexible compared to the services prices, which are more rigid. They do not change frequently. So these might actually be the reason that firstly, we might see in nominal terms that the goods consumption is decreasing, while in real terms they might not decrease as much. Also, there can be this substitution effect where the goods prices rise, then households might shift from consuming goods to services. And so if Mariam has any comments on that,
Thanks. I think I will very shortly jump into this very interesting conversation. Firstly, what we can also mean here is that once you see the rising interest rate, the first what it hits is durable goods consumption. While you see that interest, it really moderate. If you want to check it, the current stance is really restrictive or not. Firstly, maybe in terms of consumption, you should look at the durable goods consumption. While you see that one, then you can say that, yes, we clearly see some sort of moderation in terms of consumption. And regarding this consumption shifts in terms of from goods to services, it's something that we clearly see after the pandemic period, right? Shift in the behavior of consumers. Maybe we can link this to this revenge spending idea as well, because after the pandemic related restrictions easing, people started to be more to spend more and to be prone more to service related consumption stuff. I think that's what the key there, that first you see some drop in durable goods consumption, and then the service sector consumption is less sensitive to the interest rate changes rather than durable goods consumption in that term.
Okay, thanks. So, since I'm a more hawkish governor, let's say, I would bring the more main arguments to the hawkish part. So, first of all, although the core sticky price inflation is going downward, it's still higher than the inflation target of 2%. So, I believe there is still some inflationary pressures in the economy. And also, as we said numerous times, both financial and non-financial assets currently are twice as much as GDP, so it would create a lot of consumption and inflationary pressures in the economy. And speaking about of the risks, the challenges connected with pursuing case B scenario while recognizing the relevance of case A is supported by the fact that this could lead that the households would acquire more wealth and the inflation would go even higher. In response to those inflationary pressures again, Fed would rapidly and aggressively raise its policy rates, and this would worsen the credibility of the Fed, which would create a cycle of rising the policy rates, the inflation, and the worsening of the credibility. So that's the main argument for the hawkish scenario. I believe the costs are much less than pursuing the case B.
Okay.
I also want to show this graph that I have kept for the addition as an additional slide, and it also shows how this change in behavior happened when households changed their behavior from consuming durable, non-durable goods to mainly consuming services, as you can see from the bars.
Yeah, okay, thanks.
Okay, thank you very much for very interesting views. Maybe let's just keep go on our game. The next into this queue is Sergey, the student of the Global Forecasting School, and I would say the expert of UK economy. So maybe Sergey, can you please provide your views and please take the stance of more dovish policymaker, and like you can ask questions, provide your arguments as well, and yes, the floor is yours, please.
Okay, thanks, Mariam. It's quite a challenge because I'm usually inclined towards more hawkish views, given the evidence. So I will try to challenge the hawkish view now. So I would like to just provide my comments on that regard. So I would like to concentrate on several issues that I think needs to be taken into account. And I would firstly start with the tight credit conditions, which very well already have reduced the loan growth and credit growth, and in time or in the near future, they can very well weaken demand further. And this can very well be supportive towards the more faster disinflation process. And on the other hand, I believe we need to take into account that globally we have some weaknesses in the global economy, like, for example, China, which struggles a bit, as well as the euro area. For example, the German GDP has shown some contraction this quarter, as well as the euro area growth is quite weak. So we need to also take that into account, that it will have and can have some spillovers to US economy as well. As well as I think the quite worrisome issue is the fiscal sustainability, which was highlighted already many times today, that we need to be careful about keeping the interest rate high when we think about the debt, which could become in the future, and even the CBO's projection kind of indicate that they might become unsustainable, and this is an issue as well in terms of overall riskiness, as well as even for the financial stability, as the banks also hold these government securities, government bonds, and this could very well be an issue for them also. And so also just I think the final fact that we need to consider is the stock market, which could correct, because I guess we all believe that this increase in asset prices, even if it's partly fundamentally driven by the gains in productivity and AI, has some significant bubble component in it. And this is also risky if it starts to correct, or even we can have the stock market crash. We need to be wary of this risk and take the respective measures. So why I think that maybe being more dovish and start gradual cuts of the rate might be plausible is that we for sure need to be cautious and consider the scenario where there are the inflationary risks, and we should not be too dovish. But on the other hand, we can have the situation that we are too hawkish, and this can incur some significant costs for the economy in terms of too much slowdown in the economy and this kind of stuff, because our mandate is dual, right? So we also need to achieve the maximum employment apart from anchoring inflation expectations. So I think that being more dovish in this is also relevant from my viewpoint.
Thank you very much, Sergey. If Annie wants to add anything, or any other person.
Yeah, I want to show you a graph about what Sergey has just told you. So yeah, here it is about this fiscal dominance issue. As we see, I agree with that, because as we see recently also suggested and incorporated in CBO's estimates, projections for the next decade, we see that net interest rate outlays will increase approximately by 1.2% of GDP between 2023 and 2033. So these might create some incentives for households to put additional pressures on the central bank to keep interest rates down. And if you look at the CBO projections for the net interest rate, we can see that they believe that it might keep increasing. For the 2033, it will become around 3.6%. So these will raise the value of the interest rate obligations, and it might create some incentives for the fiscal dominance. It might create some risks for the fiscal dominance because in this case, central bank, Fed, might be pressured to keep interest rates down to support this huge government debt increasing. So that's what I wanted to add about this argument.
Thanks, Annie. Thanks. The next to whom I would like to ask to provide her views is Emma, our new GFS student. I'm happy to see her here. Emma, please provide your comments, arguments, and please take into account that you are more hawkish type of book governor.
Yeah, thank you so much. And I actually want to say that I'm more inclined to the hawkish side, so I'm happy about it. So my arguments, I think, will be strong. And I also want to ask a question to Ani. If she can answer it, I'd be really happy. So my question is this, regarding the consumption and saving. We saw that the saving, Ani said that saving is facing a decrease, sort of it is declining. And we see that the consumption is still increasing. Now, she brought the argument that because of COVID, we saw that the savings increased a lot. And then because the restrictions were removed, the consumption increased. But I just want to say that you said that in the future, the consumption might increase because the savings are being spent. So my question is, why is that right now we see that the savings rate is decreasing, but the consumption is still increasing really fast? So like, how could you explain the situation?
Thank you for the question. So I said that consumption might face a decrease in the future because of the fact that the excess savings have already been depleted, as World Economic Outlook suggests. But still we see that consumption is strong and it continues to increase because of many factors, because of the net worth of households they are still very elevated in their elevated levels. And this comes from these elevated asset prices as well. So we do not have to ignore the fact that the asset prices, even though they are vulnerable, they might change suddenly, but still they are very, very elevated, both financial and in non-financial terms. Also, we see that the labor market is overheated, so this might create incentives. This might create reasons for the wages to grow, even though we see that recently wages are on their decreasing path. But still, if the labor market is overheated, this might create a demand rise for the labor demand. So wages might increase again, and this will even further create incentives for households to increase their consumption levels. So even though we see cooling signs in both labor market and also in savings, we still do not have to ignore the fact that consumption increases due to asset prices increase and also the overheated labor market, and also the fact that actually the neutral rate might be higher due to this increased productivity growth, AI productivity growth. And so we do not have to ignore the fact that actually Fed's efforts to combat inflation for this extended period might not be aggressive enough. So this tightening cycle might not be enough to tame this consumption. So consumption might increase further. This is my argument for that.
Yeah, thank you so much. It actually explained a lot for me. So I'm more on the hockey side, as we have decided. So I think that my argument will be this, that we see that the consumption is actually increasing a lot, as we all mentioned already. But we have to also take into account the stock market, which shows that it is actually increasing a lot, which would mean that the financial assets are increasing a lot, and they're actually increasing way faster, I think, than the non-financial ones. We see that. So I think that because of that, the households, of course, become wealthier, which means that the consumption will increase further in the future. And even though we see that the savings rate is decreasing, the consumption is still increasing a lot, because during COVID, when we had restrictions and then the restrictions were removed, we see that people started to spend more aggressively. Now, I think that aggressive spending will not stop in the nearest future, because we see that the consumption is having a huge increase and still increases a lot. And as I said, the arguments could be the stock market, which would lead to an increase in asset prices. But I think that if we look at the labor market, for example, in the unemployment rate, if we look at that, we see that it shows an increase, but it is actually, I think it shows sort of like a healthy economy, because we see that it increases, but it's still getting closer and closer to the natural rate of unemployment. So it basically means that we still have sort of a strong economy, a healthy economy, and that basically could lead us to believing that the hawkish scenario would work better, because even though the market expects that the inflation rate would go towards the inflation target, which is the 2% for the US, we still see that the Fed decided to keep the interest rates, the policy rate steady, which means that it would be higher than what the market expects, right? And it means that choosing the hawkish side can actually bring more benefits, I think, because we see that the unemployment rate is increasing, which means that the inflation might actually be lower in the future, closer to the 2% target. So I think that these are my arguments that the hawkish scenario would actually be more beneficial in this case. Thank you so much.
Thanks, Emma.
May I jump in just for a second? Maybe Emma. Very great comments. Maybe after your comment about mainly focusing on the consumption stuff, it just led me to think about the stock market development and how would you perceive what's happening at the stock market now? Do you perceive this is driven from the fundamental factors that would again keep being in that way, or would you consider this as a bubble more?
So I think that I would consider this as sort of like a normal adjustment, because we see that the stock market, as of the last data, it is showing an increase. And I think that if it was a bubble, it would last for a shorter period, in my opinion. But we still see that the stock market is showing an increase. So even though there are fluctuations happening, so it's decreasing a bit and then increasing, I think that's really generally like normal for the stock market. So in my opinion, it is not a bubble, so it will keep increasing, yeah. Because if it was a bubble, it would take, I think, a shorter period.
So it also, I guess, from your perspective, it's validates a higher neutral as well. Okay, thanks very much.
Okay, thank you. And now I would like to give a floor to Anna. Anna is from National Bank of Georgia, and also she's from our Global Forecasting School. She's a level 1 student, and she is also an expert in the Czech Republic, in Czech economy. So Anna, can you be a dovish governor? So what can you suggest, or do you have any questions by considering that you are a dovish governor?
Yes, so to be honest, I'm more of a hawkish, but I will definitely try to act as a dovish. Hopefully I can manage that. So we're at the Global Forecasting School, we know that, and at GFS we emphasize CPI decomposition into flexible and sticky prices, and why we believe that sticky prices are very good measure for inflation expectations. We should not forget that flexible prices, we always say, provides like early warning signals. And if we look at the flexible prices currently for the US, they are definitely having a decreasing trend, and they are well below the 2%. So if we believe that these flexible prices will at some point will be translated into sticky price decrease, then we should believe that US economy will see some positive trend regarding inflation. Moving on to the also labor market, we see this labor market tightness more or less eased if we look at the vacancy to unemployment ratio, which is right back to the pre-pandemic level. So labor market is also providing some positive signals. But not just that, but also like looking at the BLT index, for example, which shows how tight conditions these banks have. They are pretty tight still, and maybe that is exactly why we see this decrease in loans, in business and consumer loans especially. And we should be expecting to keep that trend maybe going. So these were like just couple of things I could say for like as a dovish governor. If anyone has any questions, I'm free to defend my position.
Okay, thanks, Anna. Yeah, it was interesting. Do you have anything to add, or that's all?
Yes, I will add also from the savings side. This has been mentioned a couple of times, but still, like savings rate are decreasing, and these precautionary savings that we saw during pandemic has been definitely depleted, which we see from the graphs as well that we analyze. And I do believe that from the savings side, maybe what we see currently is something like people are wealthy enough and may not feel needed to save that much anymore. They don't have this sort of precautionary mindset anymore, and this depletion in excess savings will cool down the consumption and the economy in the end, maybe. Thank you.
Okay,
May
thanks.
I jump in?
Yes,
Sorry.
of course.
So regarding these flexible prices, I would say yes. We have seen that there is a decreasing trend in flexible prices, namely commodity prices, wheat and corn prices. We see that they are on their decreasing trend, but I want to say that this might be misleading in a way that, as we know, flexible prices adjust quickly to developments or economic and financial developments. And we have to be more focused on the sticky prices. For example, the housing prices, shelter prices, as I have already mentioned, they also decreased as of the March 2024. They were around 8%, and they decreased up to 5.5%. But still, compared to the 2% target, they are very elevated. Also, core services prices, which are around 5%, which is still above 2% target. So we do not have to ignore this fact, and we have to take more of a consideration on sticky prices rather than flexible prices.
Yes. I do agree. 3 month over 3 month sticky price have been also decreasing, currently at 3.2%. Maybe will decrease more, who knows. But one thing I want to add is that we have not mentioned something, that price to income as well as rent to income ratios are currently at the highest, higher than its historical averages. And we should not think that this will continue forever as well, right? Because we've seen some examples from the history, and maybe we should be cautious about this price to income as well as rent to income ratios. Thank you.
Thanks for your thoughts. Now, I would like to hear Martina. She currently joined our CBA's macroeconomic summer school. She came from Argentina. She's doing a PhD in Harvard University. So, Martina, can you be a hawkish governor? And also, I want to emphasize again that we have 7 or 8 more students that we would like to hear their performance. So, if it's possible, can you speak from 3 to 5 minutes, not exceed that range? Thank you, Martina.
Yeah, hello everyone. Yeah, I'm gonna be very quick. I'm happy to be hawkish. I know many people here would like to be hawkish and couldn't, so I'm gonna defend the position. First of all, as many mentioned, the deficit and the debt in US have been increasing since the pandemic, showing signs of losing fiscal policy. For example, the debt to GDP ratio in December 2023 was around 124%. And we can expect this to only be worsened due to elections. This is a typical thing in an election year, to have a fiscal expansion. And also because both candidates have promised things that will intuitively be developed into a fiscal, looser fiscal policy. For example, one of them promised lower taxes, other promised higher wages. So we know this for a fact. Also, there's certain political uncertainty. Current wars and the war tariff to China could affect the supply side first, And if the supply side is damaged and US couldn't get the food and energy that they need, this will accelerate prices as well. And of course, will increase commodity prices, oil, wheat, food prices, and energy. Regarding the commercial loans and credit card loans that we have been discussing, seeing that they are going down, I'm not very sure about that argument because the prices of financial and non-financial assets are going up on the other side. So maybe what is happening is that people is consuming through money market accounts and just selling their financial assets that have been proving them to increase their wealth in the last years. So they avoid the cost of the high interest rate and keep consumption strong, leading to further inflationary pressures. On the other side, as Jerome Powell said yesterday, the domestic final purchases, the private domestic final purchases is still very high. It's growing at 2.6% year over year, which shows that the aggregate demand could put more inflationary pressures in the near future, supporting an argument for a hawkish scenario. And finally, we know that the unemployment rate is a little bit higher, 0.1% higher above the target for the inflation that we expect. But that is strong but not overheated, in the words of Jerome Powell. But we don't know for sure that this will continue. It's likely that it will be likely that the unemployment might not rise with certainty. So that's all I have. And also we know from the Fed data that the wages are still increasing year over year.
Thank you very much, Martina, for very interesting insights. And
Sorry,
maybe
again, I want to jump again and comment something. So I want, as a support of Martina's, what Martina has said, she said that she doesn't believe that these tightening of the loan conditions will continue to restrict demand. I support that argument in a way that simultaneously we see that asset prices are rising. So this might indicate the fact that the collateral of households are increasing. So the value of collateral is increasing. So this will kind of create this incentive to generate to increase the loans, contrary to the bank lending tightening. That's what I wanted to comment.
Okay, thank you very much. Maybe like we are in like very case A type of world now, and let's keep this type of world. And I would like to give floor to our newly joined GFS student, bright-minded Tina. Tina, please provide your comments on behalf of more hawkish stance. And I would like to ask you to just provide maybe the strongest argument from your perspectives, from case A perspectives, and maybe on top of that, what you heard, you can add your own arguments, or just you can choose one of them that you consider as the strongest one.
Thank you for the opportunity. I have been fluctuating between case A and B, to be honest. Today I was feeling more like a B, but I'll support A right now. As far as I'm concerned, the biggest argument for case A is that we certainly see a demand pull, and where I see it most obviously is when we look at real disposable personal income being lower than PCE, and all this when there hasn't been a decrease in interest rates for quite some time. And it might be pointing to a more fundamental point of view, being driving force of increased GDP growth rate, which is succeeding our expectations. And I totally agree with Emma, who said that had it been a bubble that's about to burst, it would have busted sooner, because this bubble has been growing for 14 years now, since 2008, and maybe it hasn't burst because it's not a bubble and it's the fundamentals driving it. So if that was one argument, I think that would be the strongest one. I think there are fundamentals at play. I also want to mention that when we look at GDP growth contributors, imports is a quite high one, despite it being volatile. And why should I look at it to make predictions? I'd say that in face of having supply chain risk and with imports being so high, if something happens to our supply chains, all this import demand will be translated to domestic demand, and it will certainly increase prices even further. And another argument of mine is from Mr. Patrick Higgins' presentation, where he mentioned that real final sales to private domestic purchases, the growth rate of it, is the best predictor of if we are in expansion or a recession. And when we look at its growth rate, it does not go below zero for the last quite many periods. So I suspect that we are in a growing economy and we have inflationary pressures, then we need to at least keep the level where it is. So that were my main points. And also there is a government debt, which is a non-Ricardian view. So natural interest rate have to be higher. That was my question. And I have one short question for Annie. Annie, what do you think is the risk of, can you hear me well? I think my headphone glitch. What do you think could be the fundamental force that is boosting the youth economy? Could you identify the main driver that's fundamental? And what percentage could be a bubble, just off the top of your mind?
Thanks for the question. Well, as we have mentioned, most of this increase of the GDP comes from the consumption itself. So the main driving force should be the services consumption. And I didn't understand your question in a way that, do you want just the fundamental force or the whole?
So you mentioned several times that there is probably a bubble too, but you said that you do not expect this bubble to burst. So what do you think is the percentage, like off the top of your mind, of the bubble contributing to this increasing GDP growth that exceeds the Atlanta GDP Now's estimations? So do you think the bubble is substantial? The growth coming from the bubble, asset price bubble?
Well, regarding asset prices, I think it's a mix of both fundamentals and bubbles. And so the increase in the household net balance sheet, this strong household net balance sheet, it incorporates both fundamental things in it regarding this AI productivity growth, and also these increases in asset prices in terms of being bubble. So both of these reasons can be the reasons which drive consumption, and on its turn, consumption fuels this pent-up demand. So I think it's both. It's a mix of both fundamentals and also bubbles.
Thank you.
That's the question, if I understood correctly. Thanks.
It was a very I just want to know your opinion. Like, you wouldn't have it calculated at the beginning.
Yeah, that's I think that it's a mix of both of them.
Yeah, thank you.
I would agree with both of you, because I believe that we are exactly somewhere in the middle. Part of this stock price upsurge is driven by bubble, and part of this could be validated by sort of some fundamentals, including driven this higher neutral rate, which is validated because of this fiscal side perspectives or AI side perspectives. However, I would just still differ there. If we believe that neutral is higher because of the fiscal side perspectives. It's a kind of different perspectives for me. If we believe that it's driven by higher productivity in the AI, driven by AI, it's a different story for me. So maybe while we talk about these issues, we should also differ this, why we believe that neutral is higher more because of this AI rise, AI is increasing its productivity, and we have this better outlook for growth and longer term growth and real rates as well. Or do we believe that it's coming from more fiscal side perspective that leads us to be more in a very cautious position? So maybe it's sort of enough at this point to hear case A type of consideration, and I would like to ask our next presenter, who is Sylvie, to provide her views, but let's just focus more on dovish side of policy making, and please provide, Sylvie, your perspectives and insights from the dovish policymakers.
Okay, Madam, thank you, and thank you, Annie, for your presentation. Really, actually, I'm from a hockey side, but I will try to defend the dovish side, and I can start from the flexible price inflation, and as we all know, this is continually decreasing, and though to the currently, we can say that this impact of this flexible inflation on the overall inflation is so huge. But I think that this tendency of decreasing continues. It will have some impacts also on overall inflation too. And here are also I can mention the labor bank lending conditions, that the bank continue to tighten their conditions, and as before the first quarter ago, we can see some tendency to decrease of this decreasing in this tightening conditions. But now also we at the last quarter, we see that this tendency shifted, and the conditions also started to increase. And if this tendency also going further, we can see that say that this in some cases will also affect the consumption, and to affect its very huge growth now. And from this side, we can have some deflationary pressures. And also, I want to speak about labor market, which shows some signs of SMEs. And if we see the nominal wages growth, we can see there's the temp of this growth decreasing in some cases. And also, if we compare the average hourly earnings of all employees and consumer price indexes, we can see that difference of these two indicators also a little decreasing, which I think also is a sign of will have some impacts on consumption to decrease in the future if this tendency also going further. I think that's all for my side to defend the dovish scenario. So thank you.
Thanks, Sylvie. It was interesting. So now I would like to hear Lucas. He is a new member in our global forecasting school, and also he's participating in our summer school. He's from National Bank of Georgia. Lucas, I would like to ask you to be hawkish, and to be honest, I will not be surprised if you will say that you are happy to be hawkish, because as I noticed, only Tinutin was more dovish. So what are your thoughts? What you can say about this?
Presentation, I had almost equal amount of arguments between hawkish and dovish, so no preference, but hawkish is better. Okay, so first of all, I have two comments actually. The first one is that she mentioned on her presentation that unemployment may go up. Actually, I think that we can have the cases when unemployment could go down in the future because of this high GDP growth that we observe in the second and the third quarter. And the next one, if I remember correctly, was that she mentioned on case B type of considerations that labor market cools down. So I think it's not the very correct, I would say, because if we look at the average hourly earnings growth, we see that they are declining. They are positive but declining, but the growth from year to year is still above the 2%, so still is higher than inflation rate. So if we look at that way, this higher rate than 2% can create wage pressure into the economy. So it might be the case A type of consideration, rather case B type of consideration. So that's the case, what I wanted to mention. Um, and the third one is also that she mentioned that these tightening conditions are rising into the economy. But I think that if we observe a high GDP growth right now, there might be more stable opportunities and investment opportunities into the economy. So banks may lend more money, may issue more loans rather than tighten the conditions. So that's my personal view. I may be wrong. I don't know. Okay, that was my comment. Now the question is, um, some people mentioned fiscal dominance, and from this perspective, my question is: if we increase the interest rate, or if we keep the higher interest rate rather than lower, so if we follow case A type of scenario, will it somehow help to prevent fiscal dominance risk or uncertainty, or it will have no impact on it? That's my question.
Sorry, can you repeat the question? I'm
So
sorry.
if we follow case A type of scenario and we increase interest rates, so we keep higher interest rate rather than expected pass from the market, will it help somehow to prevent fiscal dominance risk into the economy?
As Sergey has already mentioned, that's a case where case A scenario might be risky in a way that it might create some incentives for government to additionally pressure the Fed to keep interest rates low to support the government debt. So here I agree with Sergey, and charts also show that for the next decade they expect interest rates to rise. So this creates risks for fiscal dominance. And yes, we cannot, for now, I don't think that we can eliminate these risks for now.
Thank you very much.
Thanks, Lucasi, for your question and your thoughts. It was interesting again. So now, Martin, we have here Martin. He is one of our summer school participants, and also he is studying in Northwestern University. So Martin, we would like you to be more dovish. So what can you say about US economy, or if you have some questions to Ani or anyone else?
Okay, thank you so much for the introduction, and thank you for having me here. Regarding like the dovish scenario, like to support this case, I'd like to just briefly refer to back to what Emma said about non-existence of bubbles, because I really do not agree with that. I think that there was bubble because during COVID there was like this fiscal stimulus and the changing consumer behavior, which were the primary reasons that drove the house prices and stock prices higher. But those two reasons were not enough to drive the house prices as high as they are now. So I think that there was a bubble that was formed during COVID and that still exists. And if, let's say, I'm a dovish and I think that increasing interest rates possesses more risk, then we can say that if we do not increase the interest rates, we are slowing down the economy, and maybe the economy will not be strong enough in order to deal with the bursting bubble. So we'd rather keep the interest rates either stable or reduce it a little bit in order to stimulate the economy a little bit more, so that even if the bubble still expands, this economy is already strong enough in order to handle the bubble. And if the bubble bursts, the economy is able to react. That's probably the main argument that I have for the dovish side.
Yeah. Thanks, Martin.
Thank you. Maybe a next person to whom I would like to give the floor is very like the golden Anahit, who is not here. Maybe please, Anahit. Yeah, she's here. She's the member of the Central Bank of Armenia, new member. And I'd like to ask Anahit maybe slightly different type of question to make it more interesting. I'm sure she will ace there. Anahit, please just imagine that you are with the governor and he or she is asking you to provide exactly one argument for case A and for case B. Exactly one argument for case A, which is the strongest from your perspective, and exactly one for case B. Well, what would you choose? What?
Okay, so as an advisor, I can say that for case A type of scenario, sorry, can you hear me? Can you hear my voice clearly?
No, maybe some issues. With
Now?
me, maybe with
Now?
others, no. Now better, Anna, yeah.
I think
okay, so as an advisor, I can say that for case A type of scenario, when we see this
we have some technical issues, Anna.
And we see this uncertainty in the labor market.
She's unstoppable. Maybe. Okay, maybe let's just give her some time to deal with these technical issues, and maybe we can during this period. During this period, maybe we can just ask first the next participant, who is Satanik, the GFS student, I guess the new one, and after Satanik, maybe we will have Anahit. Satanik, I would ask the same question to you as well. If it's up to you, if you have to choose one argument, just one for each case, which one would you consider the strongest?
Okay, thank you for interesting question, Mariam. Do you hearing me well? Okay, in hockey scenario, I think it's mostly driven by the real GDP growth, mostly driven by service consumption, and I will bring this argument to defend hockey scenario because we see that Tina shows us personal disposable income and it's decreasing, but personal expenditure is going high. This means that they consume more and more. And in a case B scenario, I will say about in dovish scenario, I will say about cooling effect of labor market because we see that real wage is decreasing. Mostly because hourly earnings income is the trend is going down and approaching to CPI level because it can we can assume that their real wage is decreasing and they can consume less. Also, I think that the bank lending standard is going tight, but not tightening enough to decrease consumers' consumption. But I have little question to Ani and Mariam about. Ani said that Fed not will not change its policy rate. It remains the same, but
from your perspective, when will Fed take action for not being too late? If you, as you say, the projection of market is in long term is about 2%, 2.8%, and no, sorry, market is 3.5, and Fed projection is 2.8%. And if market is right and Fed is not, it can be a good harm to their credibility. What is your opinion about this?
Thanks, Saranik. If Mariam, if Mariam lets me to answer.
For sure.
As we also talked about it with Anna, and I have already told that I cannot say a specific period when Fed should shift to monetary easing cycle. But for a while, it should be cautious in cutting the interest rates. And even if market expects that Fed will cut interest rates starting from September, even in that case, we might still need Fed to keep the interest rate constant before shifting to monetary easing cycle. So even after September, we might need this additional tightening for a while. That's what I think Fed should do.
Can I intervene, please, for a sec, because I don't want to rush through the rest of them, because we can come back tomorrow and carry on and finish.
Yes, but we have just 2 participants that left.
Yeah. Okay. But I wanted to provide a little bit of feedback.
For sure.
That's what I wanted to do. So this is the response to the bubble debate that Emma raised. So thanks, Emma. If you go back to the paper that we were talking about earlier, one by Benish and Kumhof and stuff, we considered different types of bubbles in that paper, okay, for the causes of financial crises. One is that people are just too optimistic about things, okay? So they can be too optimistic about the fundamentals of growth, but they could also be too optimistic about what the neutral interest rate is, okay? And because the neutral interest rate is used to discount everything, for equities, dividends, future dividends, and so on. And so the way I want you to think about that, Emma, is saying that there's a bubble doesn't necessarily mean it's going to burst anytime soon. Okay, the type of bubble that we're talking about, people could be, getting it wrong, for a very long period of time. They're having to forecast long-term growth fundamentals and where they think interest rates are going to go in the future. The evidence suggests that we get those things wrong persistently for very long periods of time. And so on. So I want you, when you think about it that way, the other thing is related to fiscal dominance. What we're worried about is like monetization. Okay, like when you're calling on the central bank to monetize, then there's no discipline on the government, right? They don't have to live within their means and so on. So this is the really tricky thing, because we don't like to use those kinds of policies except under extreme circumstances. And the problem now is that we're running deficits with really, really low unemployment. The economy is booming, and so the question is losing all fiscal discipline. So the question is, will lower interest rates, will that help protect us against fiscal dominance? And the answer is could be for some period of time. You can play this game where you monetize and try to keep interest rates lower. But at some point, if you keep playing that game, it's eventually going to result in the market turning against you. And so, these are all very tricky judgments. So I don't want to, I don't want to pretend that there's some easy answer, but I think that when you think about it that way, the other point is that in the paper by Yermir Benish and Mike Kumov, we showed that you can't really explain asset prices with just being wrong about fundamentals, that asset prices are just off the fundamentals for very long periods of time. And of course, you can try to be ingenious and write down a model where there's an incredible amount of uncertainty, where it makes sense for people, rational people, to be wrong over long periods of time. But at the end of the day, I think as practitioners and people have to do this in practice in real time, it's probably best just to assume that financial markets, commodity markets can be off the fundamentals for long periods of time. So, I mean, you might not have found that very convincing, and you still might not believe in bubbles, that they just seem to be these fictitious things. But I think I share some of the views that we have to think about the existence of bubbles and the possible risks. So, sorry, Mary, if you only have two more,
Yes.
then let's finish up here.
I see that Anna raised up her hand and then raised down.
Oh,
And
so
maybe if you have any question, of course, or comment, you're more than welcome.
I just wanted to add something to what Hadak has said. So this monetization thing, although I have told Dukasi that we cannot get rid of that risks of fiscal dominance, but also we do not have to let them to control us, basically, because like they will get addicted to it. And also, I want to bring a real life example of what that might result in of Israel's case during the starting of 2000s, when they followed these pressures and they cut the interest rates inconsistently with their objectives, and it led to the increase of the high risk premia, country risk premia. So we saw that 10-year treasury bond yields have increased massively, and it resulted to the expectation ratcheting upwards, inflation expectations, and we had this a huge devaluation of currency. So although we have to face these risks of fiscal dominance, but we do not have to let that risks to control ourselves. That's what I wanted to say.
Exactly, and here comes the importance of the central bank's independence. Once the central bank is fully independent, well, it does not have so much risks of fiscal dominance issues. Maybe in this regard, I would like to ask Anna if she has now dealt with these technical issues. Anna, could you please be more now in more dovish stance? I'm changing again my mind. And maybe could you please provide from your perspectives the strongest argument that would be in line with the dovish policymakers' perspectives?
Yes. First, I like to be dovish. Why? It's a very funny story, but let's start from my argument. So for me, the main argument for case B type of scenario is soft indicators and perceptions which are driving stock market correction. So I think that there is a bubble in stock market, and this bubble can correct because of perceptions and what soft indicators are showing. So we can see that PMI and consumer confidence are showing that market expectations about inflation are very optimistic. And so let's just for understand the case B type of scenario, the risk behind it, just let's imagine that
Fed will follow like case A type of scenario, and it will end up that we are in case B type of world. So in that case, we will have a huge change in perceptions and also if we have a stock market correction we can say 20% or 30%, it will have it will a result of from to other market to also have shock. So this is sequence of shocks, and this sequence of shock can bring economy in very like weak position, very weak situation. And in that case, if Fed will not react fast, it can be like very hard to go from that low inflation trap. And when I was talking at first about that funny story, so yesterday Doug asked me to explain our taxi driver, what we are doing in central bank, and I was also telling him about this case A and case B type of scenario, and he said that actually for him it's very like harmful to be unemployed and having a low inflation rather than have like high inflation. And so I think that risks which are connected with case B, like unemployment, these are more painful for people. So that's why I think that Fed need to keep eyes also with soft indicators, and maybe they can just wait till data come out and see what is the situation, for example, in labor market, because we have uncertainty there, and maybe these financial conditions are answering with delay, and maybe their policy is restrictive enough, and they need to cut rates in September. So yeah, I think this case B is more harmful for public. So I like this case B.
May I add something here on what Anna told, like about this taxi driver? Because recently I was reading a newsletter and it was about the surveying people about their financial fears. And if we do not consider the COVID, before that, the biggest recession has been at 2008. And it turns out that all people are fearing from recessionary scenario, besides Gen Zs, because the last big recession that brought this unemployment and stuff was 2008. And at that time, Gen Zs were like little children and they don't remember what is that. And maybe that is also an explanation where like we have lots of hoax here than doves. But yeah.
Yes, I agree.
Sorry, for just sorry, Leah. Just for emphasize how perceptions matter, how much perceptions matter, we can go just a few weeks ago when we had this declaration from Biden. He didn't do anything, but he said that maybe we will continue our war with China, and we had also these big banks reports about that they are waiting correction in stock market, and also investors find that because they are waiting low inflation and Fed funds rate cut, and because they were very disappointed in AI, they just started to change their investments direction, and this caused downside developments in stock market. Now, yeah, it's increasing, but I wanted to say that only one thing, but only one declaration or something like that can cause a very huge impact on stock market. And I believe that in stock market we have a bubble, and it can just burst.
Okay, Thank you, and thank you for your assumptions. So it was very interesting again, but we have one more participant left. Let's also hear Sophia, and I would like Sophia to be hawkish, but I will ask her to be like case X word governor. What does it mean? It means that can you bring some assumptions for even not just keeping interest rates in the same path as all our hawkish governors said, but also for raising interest rates. What do you think? We can't hear you, Sophia. Sorry, but we can't hear you.
Sophie, we can't hear you. Maybe.
And can you hear me now? Because
Yes.
Yes.
okay, good. Then I will tell my video turned off because there might be some trouble. Okay, the main argument for me to be a case A governor and more into the cases is that as the previous participants mentioned, there is increase in GDP, which is mainly driven by this increase in consumption, and on the other hand, it's supported by the low unemployment, so increase in wages. And if we look at data and some prior empirical evidence, when there is an increase in GDP above the potential level, and so for now we have this positive gap, this will lead to further increase in employment, so decrease in unemployment. So labor market might be more tightened in future, so wages will increase above. And besides this, if we look at US government projections for the following several 6 or 8 years, they are planning to increase this budget expenditures for 2034. As I saw, it was about 42% increase in expenditures, leading to about 48% in deficit. So there will be high increase in government debt, which will then lead to high borrowing, and there will be some risk on economy and inflation. So in this case, I suggest to increase this interest rates above the case scenario. Because if we have the low interest rates the markets need, we will have some further increase in inflation to end up in some dark corners and have negative impact on economy.
Thank you. Can I jump in? I think that Sophie mentioned really important case X type of scenario, like fiscal side consideration. And I would agree here that, yes, this is exactly what we are very actively discussing here. What if this interest rate will go far above than 5%, what, for example, Timur also described in his presentation as well, and we will end up there into fiscal unsustainability in case X type of scenarios where we will have these big recessions and inflationary pressures at the same time. Maybe on this, at this point, I'd like to thank everyone for participating into this very interesting session. And firstly, I would like to thank to my mate, Leah, from CBA for being such great as you are, and all the participants, you were great. And I think that we can just keep doing such sessions as well, maybe the next week as well. And thank you, everyone. Thank you, Ani, for sure, at first, for very interesting presentation and delivering all the comments and answers to any other UFA students. And thank you very much. And if anyone wants to also to add some comments, you are more than welcome.
Thank you too, Mariam Can, and again, thank you everyone. And to be honest, before our seminar, I had in my mind, I know that we need to take into account all the scenarios from case A and case B, but in my mind, to be honest, I was hawkish, but now maybe I also believe in those scenarios too, because you were great. when explaining your minds. Thank you very much.
Thank you. Thank you all, and see you next time.
See you.
Excellent, guys. It was really fun. I really enjoyed all the issues that you discussed, especially the unemployed comment. Don't forget about the unemployed. Okay, so thanks.
Thank you. Yeah.
Bye.